Hello there, welcome to the Open here on BNN Bloomberg. Let's get to the big stories we're bringing you from our newsroom. Warner Brothers is considering a new takeover proposal from Paramount. The Hollywood studio did not specify the terms of the new offer, but Bloomberg is reporting that it was higher than the $30 a share that Paramount was offering previously. If the new offer is deemed superior, the target here, Netflix, will have 4 days to make a counter offer. In the meantime, the Netflix agreement remains in effect. Shares in Novo Nordisk slipping in the pre-market. That stock has been a major disappointment for investors. The Danish company plans to slash the U.S. list price for Wegovy and Ozempic next year by as much as 50%. This comes as the drug maker struggles to claw back a larger share of the obesity market. The cuts will apply to wholesale acquisitions and not self-pay prices. However, they may reduce out-of-pocket costs for some patients. And some Canadian airlines are resuming flights to and from Puerto Vallarta, Mexico today. Air Canada, Air Transat, WestJet and Porter all say they will be resuming flights to and from the popular Western Mexican resort. A shelter in place was announced over the weekend after violence erupted after the killing of a cartel leader as part of a Mexican government operation. U.S. futures pointing up. That was after a choppy session yesterday amid AI fears. And of course, not only are investors worried that AI will hollow out software companies, there are concerns there'll be widespread white-collar job losses across the economy. Let's have a look at the TSX. It's closing yesterday just shy of Friday's record high. And let's have a look at oil. The Brent, the world contract, has been trading near 7-month highs. And look at that, WTI not far short of $67 US right now. There are concerns that the US plans attacks on Iran. US President Donald Trump pushing back against suggestions that the US military has been warning him that a prolonged campaign would be difficult to sustain. And let's have a look at gold, because gold has got a boost over the past few sessions on this fear, partly on this fear that Washington plans an attack on Iran. You can see gold, though, taking something of a breather today. And let's see where the loonie is, our blessed Canadian dollar, holding above 73 cents, yet not anymore. It has rallied off its lows of earlier this year, but losing altitude and now dropping below that 73 cent level. And finally, Bitcoin. Bitcoin, no joy there for the Bitcoin investors, below 63,000. Bank of Nova Scotia beating investor expectations in its fiscal first quarter. In fact, there was earnings growth across all divisions, including the crucial domestic banking operation, wealth management, capital markets, and international. The Toronto-based company has been slashing expenses, and it says that earnings growth should accelerate in 2026. We are joined by Bloomberg Intelligence Senior Analyst Paul Goldberg. Paul, you just got off the conference call. Thanks very much for giving us the time. Anything come up on the call of interest?
Good morning, Andrew. So there are a few things that I think worth pointing out. Canadian banking definitely done better than some people expected, especially with a very slow loan growth. Provisions were a little bit higher than people anticipated. So for the entire bank, things were above the range that they guided for the full year, where they expecting some of the moderation in the provision ratio going into the second half, which kind of leaves us a little bit of a concern, given that we're going into the North America treaty negotiations in the summer. Mm-hmm. So that leaves a little bit of a risk, but things were in general pretty good in Canadian banking. You mentioned international banking that held up well as well, with the slow loan growth also. Capital markets was a surprise. The revenues were stronger than expected there.
And maybe we can put up a 10-year chart for the stock. Jefferies is predicting that investors will react favorably to these numbers. Just can you give us a little more color on the crucial domestic banking results?
Yeah, I think in terms of the domestic banking, the bulk of this strength was in an interest income, even though they're trying to move some of the profitability into the fees, relying on their primacy. So that's working somewhat. They've been having some cross sells into wealth, which is helping as well. But in general, it's been sort of a sluggish growth because they did have some of the restructuring done in the fourth quarter and charges taken. They took out some of the costs that it's helping as well.
Mm-hmm. And sorry, just remind us what happened with the provisions for credit losses. So they came in at just under 1.2 billion, and that was higher than Canaccord had estimated, and quite a bit higher than consensus. Just remind us what happened there.
Yeah, as a ratio for the entire bank, the total provisions were 61 basis points. The impaired provisions, which they guide to for the full year, in the high 40s to the mid 50 range, those were actually 58 basis points. So those were higher. They did mention 3 basis points of extra provision in global banking and in markets, which could be kind of lumpy and idiosyncratic. But in general, there was some pain in the domestic banking as well.
It's interesting how we focus obviously on the Canadian banking. Underlying profit there coming in at 1.9 billion, up 5% year over year, pretty handsome. But international banking is such a big source of profit for them. Underlying earnings there about 1.5 billion.
Yeah, they did mention some good stability across the international banking. Some of the questions on the call obviously came up in terms of the instability in Mexico, but they did say that all the branches are reopened. So they are seeing some gradual growth and some improvement in productivity in those markets.
And expenses up just over 3%. Do you happen to know, was that in line with what the street wanted to see?
It was roughly in line with expectations based on consensus. But again, as I just did mention, they did take some restructuring late in last year. So even though they invested into technology, some of that was kind of front-loaded by the cost savings that were especially on the compensation side.
And you may have touched on this, sorry, Paul, but return on equity. So management said or suggested here that they'll top 14% return on equity ahead of the schedule. The schedule was for 2027, but they're going to reach that profitability level earlier.
That is actually almost correct. So the schedule was for 2028. This was coming from the investor day about 2 years ago. They are saying they will get there in 2027, a year earlier.
I see. Sorry. So I thought the target was 2027. And
they actually previously noted that as well, kind of getting to those numbers. And it's mostly driven by Canadian banking and buybacks.
Right. And Canaccord says, well, they'd put a plus on there, 14% plus return on equity. And Canaccord says that'll catch investors' attention.
It would definitely help, especially at the consensus at 13.5 for next year. So it's a better number than people are expecting.
Thank you very much, Paul. Really appreciate it. Paul Goldberg, Bloomberg Intelligence Senior Analyst. Coming up next, Canada's ambassador to Mexico says that nation appears to be in a period of stabilization after the weekend's violence and unrest. Canada's ambassador to Mexico says Mexico seems to be in a period of stabilization after violence and unrest rocked Puerto Vallarta in Mexico on Sunday, and it spread to other regions. Let's get more from CTV's Scott Hurst. Scott, At one point, Puerto Vallarta was being called a war zone. Just remind us what Canadians have been experiencing on the ground.
Andrew, good morning. It has been an unsettling and unnerving 24 to 48 hours for many Canadian travelers in these popular Mexican resort cities impacted by this cartel violence. We've spoken to many over the last couple of days who have described what it was like to be under a shelter in place, many saying that they saw cars and trucks set on fire, at the very least saw black smoke billowing on the horizon, and then forced to shelter in place as this violence erupted. But Mexican authorities deployed thousands of additional Army and National Guard troops to help restore order in the wake of the killing of this cartel leader and then the retaliation from the cartel. It appears the initial violence and the very public retaliation for now has subsided, and with that a sense of order quickly returned, at least from the tourist perspective. We're now seeing flights returning to a relative normal. Many of Canada's major airlines that fly to these resort cities in Mexico, Air Canada, WestJet, Air Transat and Porter, are all resuming operations to Puerto Vallarta today. Now, from the airline's perspective, Andrew, is a task of working through that backlog of the many postponed and canceled flights, and customers who are supposed to fly out on Sunday or Monday now trying to rebook and ensure that they can get home relatively easily after having their flights postponed or canceled.
And what are the actual prospects of Canadians getting home, Canadians who are already there?
Well, now that the flights are resuming, for many who had flights booked from today and the days ahead, it'll likely be relatively normal for them to get back to Canada. For those who've had their flights canceled over the past 24, 48 hours, of course, they're now trying to deal with getting flights rebooked or dealing with accommodations as well to figure out how they can stay for a couple of extra days. So, of course, there is a lot of the burden right now to figure out how to get home, but now it appears there will be a path home for many Canadians who have been in Puerto Vallarta and some of these other resort towns that have been impacted by this cartel violence.
Just incredible. And so, Scott, it isn't clear exactly how some of these people, when they'll be getting home. I mean, obviously, it's a massive operation. So many people are there.
Not specifically for many who've had their flights canceled or postponed, so it's not clear exactly how quickly they might be able to get home, as these airlines are now trying to deal with the surge of interest of people trying to rebook and get on flights as quickly as possible, and of course having to deal with accommodations as well. So if someone can't fly out for several days, there's the added task of trying to ensure that they have the proper accommodation before they can get home to Canada.
Scott, thank you very much. Scott Hurst, our colleague at CTV News. On February 24th, 2022, Russia invaded Ukraine as the war enters yet another year. Peace talks are stalling and fighting is largely at a stalemate, despite U.S. President Donald Trump's peace efforts. Allies say the U.S. is in fact pushing for a deal before Trump hosts the 250th anniversary celebrations for American independence on July 4th. Bloomberg's Oliver Crook breaks down the situation.
As we enter now the first day of the fifth year of this war in Ukraine that began before the dawn on February 24th of 2022, you have the European Commission President Ursula von der Leyen, the Council President Antonio Costa. They're in Kyiv today, and they were hoping to bring with them not just their presence in order to mark and remember this date for the Ukrainians, but also some financial support in the form of a 90 billion euro loan that had been agreed to at the European Council a couple of back in December, which now has been brought into question by Hungary, but also the sanctions package that was tried to be passed yesterday, and there were objections from both the Hungarians and Slovakia. So this obviously puts a damper on sort of the what the Europeans are hoping to bring to the table, already trying to struggle to find their voice in these negotiations between the United States, Ukraine, and the Russians. We heard from Antonio Costa, who was writing to Viktor Orban. So there was the sanctions as one issue, and now Viktor Orban is objecting to the loan to Ukraine, 90 billion euros, which is obviously, Vani, fundamental, because this will guarantee that the war can be funded and much of the Ukrainian budget to 2/3 of that for the next 2 years. That is now being called into question because of this lack of unity at the European level. So Antonio Costa wrote a letter to Viktor Orban in which he said, a decision taken by the European Council must be respected. When leaders reach a consensus, they are bound by their decision. Any breach of this commitment constitutes a violation of the principle of sincere cooperations. Now, we also know with interest that these two nations that are now objecting to this are the two nations that Marco Rubio Rubio decided to visit after Munich Security Conference. He was first in Munich, then he went to Slovakia, then he went to Hungary. Does that put these two leaders potentially in a more emboldened positions because they have this sort of tacit backing from the United States? But for the Europeans, again, this is going to be the big story for the next couple of months. How do they bring their own pressure to bear now that they have so much internal division, which is now effectively blocking their most significant contributions to Ukraine?
Yeah, absolutely. And Ollie, the outlook for broader peace talks spearheaded by the United States, I mean, as moderator, is the U.S. getting anywhere here? Is it siding with one side more than another? Because it had been trying to bring both sides together, but surely there's difficulty there.
So what we've been seeing from the United States is, as you can see, from time to time, Trump sort of vacillates as to who he decides is the impediment to peace. It's very often, historically, very often been Zelensky in the mind of the president. It has sometimes been Vladimir Putin. And there are options on either side of that for the United States to bring sort of pressure to bear. It has seemed to be a sort of more finely balanced view right now that we're getting from the president of the United States. You know, of course, ending the war in 24 hours was the initial goal. It seems now the president has aimed basically July 4th this summer to try to get some sort of resolution over the line. That's obviously significant because it's the U.S. Independence Day, the 250th anniversary of the country, but also a win that the president of the United States would like to carry into the midterms, which seem pretty precarious for the United States. Not to say nothing of the fact that there could be potentially implications for the price of oil and inflation. All of that is very important for the United States. That being said, Vani, the last update that we have really heard, and has been for Marco Rubio in his tour of Europe, was that basically some days he feels pretty good about it, some days he doesn't feel that good about it, and that basically it's not clear whether or not there will be a deal. So we'll be watching it again very closely. The important thing, Vani, will be to see who the United States will put pressure on, whether it's Ukraine or the Russians.
Nations across the globe are pushing back against U.S. President Donald Trump's latest tariff threats. CTV's Judy Trin reports.
My fellow Americans, this is Liberation Day.
Donald Trump's use of emergency economic powers to impose tariffs has been shackled by the Supreme Court, but the White House says it will use other tools to get what it wants.
We had to look at backup plans, and we found ways to really reconstruct what we're doing. Now it doesn't have the same flexibility.
Trump says he'll now impose new 15% global tariffs to replace the ones deemed illegal. He warned against playing games and threatened much higher tariffs if countries back out of trade agreements. In the past year, the U.S. took in more than 240 billion Canadian dollars in duties.
He needs to return that money, needs to refund that money with interest. He can do that in a nanosecond.
Lower courts will decide if refunds are needed. Amid the uncertainty, the European Union is pausing ratification of its deal with the U.S.
We are trying to maintain predictability for businesses, for consumers, in the face of some substantial unpredictability.
The Supreme Court decision won't apply to tariffs that are devastating Canadian steel, aluminum, automobiles, and softwood lumber. Earlier this month, some Republicans joined Democrats to vote against Trump's tariffs on Canada. Ontario's premier emphasized the president's weakening support.
We saw what happened in Congress. We saw what happened in the Supreme Court. The walls are closing in, I believe, on President Trump right now.
Protected under CUSMA, most Canadian companies will be exempt from Trump's new tariffs. The Prime Minister has yet to comment on the president's new threats, but Mark Carney is preparing for an overseas trip. He's heading to India, Australia, and Japan later this week to increase trade with those nations.
And as usual, confusion reigns around the Trump White House. The U.S. has, in fact, imposed a new tariff now of 10%, according to Customs and Border Protection. At one point, President Trump was announcing a 15% levy. Up next, we'll bring you a check on the markets and look at some of the stocks on the move before trading opens. Let's take another look at U.S. futures. They did bounce after yesterday's losses, but you can see the S&P now looking at a pretty flat open. We did see at one point the Dow yesterday down almost 2% on tariff fears and also software stocks yet again being blasted by AI fears. Some stocks that are on the radar can't get away from AI. Investors happy to see that AMD has struck a deal with NVIDIA, under which Advanced Micro will supply chips and other technology to NVIDIA, but there's the usual back scratching here. So Meta is going to use gear from AMD. It's a deal worth, quote, double-digit billions. Meta's buying AMD chips, etc. But there is some back scratching here because Meta gets warrants to buy 160 million AMD shares in stages. So it's not a straightforward equipment sale. They have to bring an actual bit of circularity to it. Planet Fitness is on our radar as well. That stock down about 6%. The operator of fitness clubs providing a profit forecast that fell short, or looks like it falls short, of Wall Street expectations. And IBM is under pressure as well. IBM has a long-standing programming tool called that runs on its computers called COBOL. Oh, there is IBM. I'm sorry, IBM was down earlier. Okay, so that the sell-off yesterday. So IBM now up a little bit, but let's put up a one-year chart. Wow, IBM shares as of this morning were down 27% in February, and the biggest one-month slide since 1968. So the pessimism here is that Anthropic will modernize a COBOL systems that Anthropic claims this used to require armies of consultants spending years mapping workflows. But now Anthropic says tools like its Claude Code AI can automate the exploration and analysis phases. So IBM saying that its core mainframe computers offer a platform that offer the same quality for various languages, not just COBOL. But investors concerned that IBM which was something of a pioneer in artificial intelligence over the years, is vulnerable here. Let's have a look at where the Asian markets finished, and you can see a mix showing generally, but of course investors around the world nervous about where Trump's tariff war goes next. We got the opening bells next. There you have it, the opening bells at the NASDAQ. ASP Isotopes is doing the honors. In New York, it's Lower East Side Partnership. And in Toronto, it's Russell Investments opening the market. It's time for First 15. Let's have a look at Toronto as we get going on this Tuesday morning. And Toronto stocks slipping slightly, still down from their Friday record high close. You can see U.S. stocks, which were pointing upwards earlier in terms of futures, now weakening. And of course, this ongoing fear of damage to the software industry's profitability hanging over the market. Some stocks of interest here. Let's have a look at Scotiabank beating expectations, and that stock trading in record territory right now, even if it's not quite at a record. It looks like there was fairly a beat across the board here, including in domestic banking and international banking, although provisions were a little higher than some analysts had expected. I'm just trying to check here. It looks as though, where is Scotiabank? 104.50, not quite back at the record high of last week. At one point last week, it topped $105, but certainly pretty close. And let's have a look at Thomson Reuters. It is trying to push back against investor concerns that AI will demolish its business, vast business of selling data. Thomson Reuters insisting it has artificial intelligence tools itself that will make it much easier for lawyers, for example, to interrogate precedents. It has this thing called the AI-enabled co-counsel technology. And it's interesting as well, the Chief Product Officer, David Wong, quoted in the Globe and Mail today by James Bradshaw, he's a great reporter, as saying, we're actually in a bit of a return on investment crisis. He claims that businesses have been experimenting with AI, but they're struggling to show results. Well, of course, Thomson Reuters would say that. Let's have a look now at AMD. It's got this deal with Meta. We started off with Air Canada. I'm sorry. I missed Air Canada there, but of course they are, along with other airlines, flying to Puerto Vallarta again. Thanks, control room. Stock not reacting much. Let's now have a look at Advanced Micro. Meta Platform's going to buy a whole bunch of gear, but also get warrants to buy Advanced Micro. So it's a little circular. The deal pushes up Advanced Micro shares, but Meta gets warrants that profit when the stock goes up. So we are seeing more of that mutual back scratching we've seen in the AI market. Whirlpool shares did come under pressure, down about 9% after the maker of kitchen appliances announced a bid to sell stock. Investors not thrilled about the potential dilution there. And Keysight Technologies up. This is a giant player in measurement instruments. Stock edging up, but it's had a great run over the past year, up almost 40%. The company predicting above 20% growth in revenue and earnings in fiscal 2026. And part of that is booming AI, along with faster growth in other areas, including wireless and defense. Up next, so we're getting the Canadian banks turning in their earnings for the latest quarter. Scotiabank beat expectations. We'll have more after the break. Bank earnings season ramping up, and a lot of our big lenders are trading at or near record highs. Scotiabank turned in its first quarter report card, beat expectations with higher profits across its business segments. Let's get some more from Brian Belsky, CEO and Chief Investment Officer at Humilis Investment Strategies. Brian, great to see you, and thanks very much indeed.
Thanks for having us, Andrew, and good morning, Canada.
What jumped out for you with the Scotiabank numbers? Anything interesting?
Well, I think, the big six banks have done a wonderful job in terms of managing their capital. We've said for years and years that Canadian banks are the most excellent stewards of capital in the world. And, last year, meaning 2025, was a year where the banks were starting to use off of the excess reserves that they were really building through much of 23 and 24. And so the benefits of that are really even following through into this first fiscal quarter for 2026 for the banks. We worry that the Canadian economy might be slowing a little bit faster than the U.S. economy. We worry that Canadian banks in general have had such great performance from a fundamental perspective. That they've spent a lot of money with respect to divisions as well. But Scotia in particular is going to follow and set the trend for what we believe we're going to see for the rest of the banks, meaning good capital markets perspective and volumes during the quarter because of the volatility. Wealth management, especially at Scotia, they've kind of righted some of the branding ships and some of the issues that they've had there. So I do think that Scotia's kind of setting the pace in terms of some of the other banks. But by and large, the banks in general, we think in our view at Humilis is that the banks are going to be much more selective versus last year. They all kind of went up in unison. So you're going to have to increase your stock picking chores within the big six banks.
So, but Scotiabank would be one of the bank stocks you favor, Brian?
Well, we own Scotiabank in one of the 8 model portfolios that we run for clients, both Canada and the United States. We own it in our North American dividend growth portfolio. This is a company that has consistently raised its dividend over time and has great free cash flow yields above the dividend yield with respect to being more tactically positioned in National. I think there's other banks like RBC and National that we would prefer with respect to tactically over the next 12 to 18 months.
Royal Bank and National. What would appeal to you with National? I mean, they have been growing rapidly. They just pulled off a big acquisition. Is that part of it as they squeeze profits out of that?
Well, I think number one, management. Their management has been in place for a while, especially relative to some of the other big banks. And number two, they pulled off a great acquisition out west. And as you know, the West is growing from a population perspective and a GDP perspective a little bit more consistent than what we've seen in the East. And number three, from just a pure growth perspective and how they manage their individual divisions, we have a lot of confidence in.
What about the big U.S. banks? Are they drawing your attention at all, Brian, the JP Morgans and the Bank of Americas?
Yeah, Jamie Dimon, once again, sets up for everybody to be worried. He likes to underpromise and overdeliver. And, he puts his money where his mouth is. Remember, he was one of the CEOs that still remained from the credit crisis. And he's been making comments with respect to what's been going on in terms of private credit, but then also AI. Two of the things that most investors are worried about with respect to financials. We still love financials in the United States from a thematic perspective, Andrew. And the themes are kind of a big barbell. On one side, we like the big banks with respect to the scalability of JP Morgan, Citigroup, Bank of America, especially Bank of America in terms of their Merrill Lynch division. And then we like the really small banks because of the relationships that they're able to maintain with respect to growing the commercial banking side and the individual banking side. So the in-between banks, quite frankly, more the super regionals are the ones that we more worry about because we do think they can't compete with the small and they can't compete with the big. So I think the banks that you just had up there, including Wells Fargo, I think from over the next 12 months are where you want to be, especially as I think a lot of people are forgetting that regulations are going to go down in the big banks and the funding mechanism, we think, as interest rates continue to go down as well, that affordability is going to get better, and we're going to have another real estate increase in terms of real estate prices continuing to go up.
Brian, what about Home Depot? You say investors should watch out for misleading signals here?
Yes. Now, Home Depot is a bellwether retail stock. Now, remember, in the fourth quarter, people spend their money in the United States a little bit differently than they do the rest of the year. Last year in 2024, we had an additional fiscal week as well for the fiscal year. So that was what the numbers are a little squishy. If you look at continuing operations earnings on Home Depot, they beat the number. Home Depot is about the consistency in earnings for Andrew. It's not about this go-go growth side of things. And especially given the fact that consumer sentiment has been weaker, Home Depot is an area where it's more actually of a consumer staples retailer, and we've owned it for several years in the portfolios that we've been able to run. And so Home Depot, we think, is one of those names that you want to own in a market like this.
What about the U.S. consumer, Brian? We've heard endlessly about this so-called K-shaped economy, the lower income people struggling. Any thoughts on that? I mean, are you avoiding companies that tend to be more dependent on lower income people's spending habits?
No, because if you take a look at where Walmart has done the last, let's say, 12 to 24 months, low income to medium sized income are still spending their money at Costco. Costco, we believe, is a top 25 company in the world. And then if you also take a look at where Amazon in the price differential and the price breaks that they're giving investors, Amazon underperformed last year. And a lot of people missed that. I think the consumer discretionary sector last year had a much more volatile time. Remember, Tesla is part of the consumer discretionary sector. So that's what really drove that sector higher, where Amazon had more issues. And Amazon was really beaten down from the AMS division, not so much with respect to what's going on with the consumer. So from the pricing side of things, investors in the United States especially are much more price conscious. They're smart about how they're going to buy things and buy things in volume. And I think that's why the Costcos, the Walmarts, and the Amazons from us still make a lot of sense. And then from a thematic perspective, from smaller mid-cap stocks, we still like a stock called Shake Shack because we do believe that company is the next big theme in restaurants. And we do believe that the volume and how they're opening up stores, Andrew, is very, very smart.
Shake Shack, yeah, excuse me. I believe part of their shtick is our burgers are better quality.
They are. So, our theme for Shake Shack is we think Gen Z is to Shake Shack what millennials were to Chipotle. Millennials like to be a little bit more healthy. Shake Shack is talking a little bit about that, but Gen Zs are about living what's going on right now today, living today, and they want to go have their burger with their large pop and their French fries. And I think that's a major theme, and why Shake Shack, we believe, from a fundamental and thematic perspective, is much more positioned better, than Chipotle.
Thank you very much, Brian. Always great hearing from you. Brian Belsky,
Thank you.
CEO and Chief Investment Officer, Humulus Investment Strategies. Yesterday on Market Call, we were joined by Jerome Haas, Portfolio Manager at Lightwater Partners. The top 8 Canadian mid-cap stocks. His top picks were Total Energy Services, Surge Energy, and Fairfax Financial. Today on the show, it's Ernest Wong, Head of Research at Baskin Wealth Management, and he'll be taking your questions on North American large caps. Just ahead, Europe is warning that trade deals with the U.S. may be at risk after U.S. President Donald Trump's move to put, it was going to be 15%, now it's going to be 10%, is the latest we've heard. We'll have that story after the break. Europe says trade agreements with the U.S. may be at risk after the White House announcement over the weekend of a new 15% global tariff on all imports. Now, initially, this is being imposed at 10%, the U.S. Customs says, but a White House official told the Financial Times that the rate will be raised to 15%. We were joined by Sean King, Senior VP at Park Strategies.
His new random tariff that he came up with through Section 122 is 15%, which is what the EU had anyway. But the thing is, it's not done on the so-called reciprocal basis that he announced on Liberation Day. He just pulled it out of thin air. And it can only last for 150 days. And it's illegal, as per the Supreme Court says. So the EU is like, why are we going to be bothering paying this investment and buying this energy and opening our markets if your own court's not even allowed to charge what you want on our products? So whether or not it's a violation, I'm not sure, but it definitely makes Europeans think, if it's 15% today, what will it be tomorrow? And what will he do after these expire in 150 days? And what happens if Democrats win Congress in November? What if Trump just decides to ignore the Supreme Court in general? Like, what are we dealing with? So I don't blame Europe for calling a pause on this and seeing what's what before asking its 27 member states to ratify this deal that was made based on another understanding.
Yeah, so you think that this is a good idea by Europe, the EU, to say it's going to actually suspend the ratification of this deal just until they get more clarity, or is there more clarity really coming?
Well, I am an American, and obviously I'm not in the business of advising foreign governments. But if I were the EU, I would totally wait and hold off. I don't blame them at all. This is a huge setback for the Trump administration. And I mean, would we negotiate anything with Europe if their own courts were telling them they couldn't do something? I mean, we would do the same exact thing. And I think we're just going to get more confusion going forward, because these tariffs will last 150 days. Then Trump's going to threaten to override the Supreme Court. Then he may lose control of Congress anyway. So anybody wanting clarity, they're going to be left wanting for a while, because I think things are only going to get more chaotic. I hope you didn't have me on the show to offer you answers, because I have probably more questions than you do, and I'm actually here.
No, I think at this point, most people know that we're kind of guessing what's going to happen, because things change so rapidly in this environment, right? But there have been a number of trade deals signed recently with the U.S. If you look at some of the U.S.'s Asian trading partners like Japan and South Korea, could what Donald Trump is threatening now jeopardize the trade deals that are already signed with those countries?
In some cases, yes. In other cases, no. And before we leave Europe, even though the UK is not in the EU, it is still part of Europe. And ironically enough, the EU trade deal, which is now called the Turnberry deal, was signed in Scotland, which is no longer on EU soil. Now, the UK is really getting screwed here, because their trade tariff on their products, which Americans pay, which this Supreme Court decision finally makes clear, the fact that we're even having a discussion about the cumbersome process of possible refunds to U.S. importers proves once and for all, despite what President Trump says, it's actually Americans who pay the tariffs and not foreign countries or companies. But the UK had negotiated a 10% tariff on its products. So now it's going up to 15%. So the UK must be very upset by what's going on. Same goes for Singapore, because they were down to 10%, as well as Australia and Saudi Arabia. But then, like, say, Philippines, they negotiated 19%, Vietnam 20%, and India is about to finalize a deal for 18%. But I heard their delegation canceled their Washington visit this week after the Supreme Court ruling. Now, 3 big Asian agreements: Japan, Korea, and Taiwan. Japan's a parliamentary democracy. With her new supermajority, Prime Minister Takaichi, I see her picture there, great timing. She can run this through Parliament no matter what, the Diet. And the fact is, Japan's already the #1 foreign investor in the United States. So a lot of these deals were going to happen anyway, and they can sort of fudge it in terms of loan guarantees. And they've so far only put up $36 billion of their promised $550 billion. And whatever kind of tributary payments they have to make to Trump as part of some protection racket, they see it worthwhile to lock us into the alliance against mainland China and North Korea because they're so insecure in the region, understandably so. Korea and Taiwan are very different, though, because they follow a federal system like we have in the U.S., where the president and the legislature are separate. So they have to sell it to the legislature. And neither legislature has approved the deals their leaders signed with Trump. Now, in Korea, it's the same party between the presidency and the National Assembly. So it's probably just pro forma that it's going to get passed. But in Taiwan, it's a very different story. You have William Lai of the Democratic Progressive Party, which, despite its sound, is not a left-wing party. And then you have the KMT and the TPP. They run the opposition, and they want friendlier trade relations with mainland China. And they're promoting this idea of U.S. skepticism on Taiwan. And just this weekend, a KMT rep say, why are we turning over the crown jewels of Taiwan Semiconductor to the U.S. if Trump's own court won't allow the tariffs?
Yeah.
So this could put into great jeopardy passage of the agreement as it regards Taiwan.
We have just 1 minute left, but I want to get in one last question. Donald Trump preparing to meet with Chinese President Xi Jinping in April. Does this threat that he's making kind of give him less leverage in terms of negotiating now?
Definitely, because Xi is playing the long game. He is also focused on his own sense of decoupling. He doesn't want to depend on us for any technology, especially when we can put on further export controls. I support decoupling anytime President Trump wants to get tough on the PRC. I know you guys want to sell him your canola, but it's bad news over there. So I would say stay out of mainland China. But now Trump knows that Supreme Court is going against him. So this definitely gives Xi Jinping leverage in dealing with Trump. And obviously, they'll also argue about Taiwan and whatever else.
Sean King, Senior VP at Park Strategies. Always enjoy hearing from him. Coming up, we'll check out some of the stocks on the move in early trading. Right, let's get to some notable analyst calls this morning. Let's talk T-shirts. Gildan Activewear's target is being raised by RBC to $79 US from $71. RBC sticking with a buy rating on the shares ahead of its Q4 results. RBC says one thing encouraging us is the closing of the Hanes brand acquisition on December 1st, and the analyst sees brighter news for the valuation on Gildan ahead. Look at that, the stock up 31%. And Yum Brands, let's talk fast food. That company also getting a price target raised to $170 from $160 at JP Morgan. JP Morgan sticking with an overweight rating on the shares. If you overdo the food, I guess that's what you risk. JP Morgan saying we're revaluing the restaurant group for, quote, growth quality. And it says get into this stock opportunistically on pullbacks. Do we have a time to look at Whitecap, the oil and gas producer? Raymond James is raising its price target on that stock to $16 Canadian, saying that Whitecap posted a solid exit to a transformative year. Of course, the company's been an aggressive acquirer over the past few years. Productivity has been nudging higher. Reserves were up. Of course, they just took over Veren, and RBC reckons that Veren now fully integrated. So Whitecap getting a nod of approval there from Raymond James. Okay, did I say RBC? I meant to say Raymond James. Let's check in on the equity markets. And there is the TSX under a little bit of pressure right now. Of course, it's been rocking and rolling for more than a year now. I'm just having a look at the spot gold price because that's been a big driver for Toronto lately. Spot gold, where are we now? Because there's the TSX. Spot gold slightly down today, 5,131, and it was almost 5,230 yesterday. So we have seen some selling this morning in the precious metal stocks. Let's have a look at oil because, as I mentioned earlier, the world oil price near its highest in 7 months. There are fears that the U.S.-Iran talks will stumble. U.S. President Donald Trump says, I prefer a diplomatic solution on Iran's nuclear program, but warning of consequences. Now, the latest we've heard is that the talks were set to resume on Thursday in Geneva, with Trump's special envoy and son-in-law expected to meet again with the Iranian foreign minister. Got to take a break. We've got lots more earnings for you ahead. Welcome to the second hour of the Open. Let's check out the big stories we're bringing you from our newsroom. Bank of Nova Scotia topped estimates on better than expected results in its fiscal first quarter. The Canadian banking division was strong, but the bank saw earnings growth across all divisions, also including wealth management, capital markets, and international. The Toronto-based company has been slashing expenses to improve operations. It says earnings growth should accelerate in 2026. Shares in AMD up around 6%. Meta is going to buy AMD chips and computers designed to run AI models over a 5-year stretch, beginning in the second half of this year. According to the chipmaker, the transactions will be worth double-digit billions of dollars. As part of the arrangement, Meta will receive warrants to buy 160 million AMD shares. Last week, NVIDIA disclosed a similar tie-up with Meta. Bloomberg News says Canadian generic drug manufacturer Apotex is looking at the first half of the year for an initial public offering that could raise as much as $1 billion. An IPO of that size would be Canada's largest debut since 2021. The report says no final decisions have been made on the exact timing or size of the offering. Apotex was founded by the murdered Canadian businessman Barry Sherman. And there's a look at the TSX, as mentioned, still down from Friday's a record high close. And let's zero in on the US. Stocks weakened earlier, but they are pointing up right now. We have seen a rally in a couple of these beleaguered software names, CGI in Toronto higher, and also Thomson Reuters. So we're tracking a whole bunch of earnings. Scotiabank beating expectations. Whitecap topping guidance. Raymond James raising the price target there. Let's get more from Brooke Thackeray, research analyst in Global X Investments Canada. Brooke, great to see you, and thanks for joining us. Give us your thoughts on Bank of Nova Scotia, please.
Well, they were decent earnings because they're right across the board with all divisions. Really, the divisions that were carrying the big weight was the capital markets and the wealth management. So the consumer loans really wasn't particularly strong. And you can't go against these earnings. I mean, they're good, but the Canadian banks have actually done so well for so long, and these earnings were largely based upon a lot of cuts being made. They actually just slightly underperformed on their revenue. And so I think the Canadian banks from here, and the Bank of Nova Scotia, they've done so well, they've outperformed the market, but I think we're not going to see that continued strong outperformance from this point.
Broadly speaking, you think the banks won't be, they've done so well, as you say, over a year and a half, but you don't see further gangbuster gains?
No, I don't. I think, unless we see some big, huge, amazing earnings coming out with stronger revenues, and there's still some concerns around the consumer and the housing market. So if we start to see unemployment go up, and that's the underlying concern overall. I mean, the bank didn't reflect that, but investors still see that as a little bit of a concern. So I think there's going to be muted gains at this point, maybe market performance rather than outperformance.
What about Home Depot? Is that a stock that attracts you right now?
Yeah, I'm a little bit surprised at the strength of this. Here we had Home Depot come out and beat expectations. Same store sales was up and outperformed. So we saw the same store sales come in at 0.4% growth, which is a positive. So their outlook for the economy is quite resilient. They're saying the economy is still resilient. We're not seeing any signs of deterioration. They did make a comment saying that the consumers were concerned about the go-forward basis, perhaps unemployment. So there seems to be a disconnect about what's happening and the sentiment from consumers. But overall, Home Depot actually, those were solid earnings for sure.
Would you be a buyer though of Home Depot right now?
Yeah, I think so. I think Home Depot can actually go from here. We don't see a downturn with Home Depot in a strong seasonal period as well right now. So I think Home Depot can actually do quite well from here.
Whitecap Resources, it has been a favorite among oil and gas investors. They've been an aggressive acquirer of other companies, just bought Varen not that long ago. Maybe we could look at a 5-year chart. Would this be an oil and gas name that you would tend to buy?
Yes, I think this is a very good choice for oil and gas. I mean, the big question was, how would the merger with Varen go? It's gone extremely well. If you take a look at the production of Whitecap Resources, it came out at 370,000 barrels of oil equivalent, which was 10,000 greater than expected, actually. So we saw them beat on the expectation of production with the merger. So the merger was completed last year, May 2025. So that's actually gone really well. And so that was the question. It's been handled extremely well. I think this is a great company. It's now the 7th largest oil and gas company in Canada. And I think it's well placed for the future.
Well, what about Constellation Energy? It's been a darling among investors who are betting on massive electricity consumption in the States.
Yeah, so they actually came out with very solid earnings as well, raised their dividend, beat on revenue substantially. But if you take a look at the results so far this year, they've actually not done that well. And the reason for that is the fear about price caps on the energy or electricity. And that's the big concern with the whole AI and the data centers and who's going to pay for it, how much and when. And so the concern was that was going to come back to the nuclear providers with price caps. But I think these earnings are great with the revenues up so strong. There's still going to be an underlying concern about price caps until that gets worked out. I don't think we're going to see the sector run extremely well. I think these are great results. So,
Thomson Reuters, there's a story in the Globe today by James Bradshaw. Thomson Reuters is saying a lot of companies have invested in AI, but they haven't earned the return they hoped. Now, Thomson Reuters, of course, has been under severe pressure and fears about AI. Do you think that's, I mean, I guess that's inevitable. Some people are going to blow it on their AI investments, at least initially.
Yeah, so as far as, because there's so much money going in, it can't all be done very efficiently to begin with. Mm-hmm. We're going to see it's a lumpy process, basically. And, we're seeing this all over the place. I mean, and expectations in the market are changing dramatically on a daily basis as well. You just take a look at what happened yesterday with Citrini Research coming out and releasing a fictitious report of what 2028 would look like. And you saw, American Express and other companies go down over 7% based upon that report. So there's just a lot of it's having to work itself out. This is not a smooth ride. I mean, in the beginning, when we've taken off for the last few years, we've seen a very smooth ride, relatively speaking. But I think we're going to see more of a bumpy run on a go-forward basis.
Yeah, and I'm not sure if you heard, there's a widely discussed Substack essay today predicting that the AI's influence on the economy could be damaging in the sense of vast numbers of white-collar workers losing their jobs.
Yeah, I mean, I'm not sure. Was that the Citrini report that came out yesterday? It was put in Substack, maybe. Yeah, and that's that. What was interesting about that? It's a fictitious report saying that the amount of white collar jobs are going to be lost, and it affected the stock market so much. For me, this says. What it really says is that investors are starting to get a little jittery here, and we're starting to see some big moves on things like fictitious projections. I mean, Citrini Research is this thematic research house, and it's not like they actually have all the numbers behind it. They're saying this is what we anticipate in the future, and yet it can move the market down so much. That is really a testament to what's happening with investors and the sentiment. They're starting to get a little bit concerned about how this is going to play out.
When you say fictitious, you mean it's based on speculation and projections?
Yeah, it's just, I say fictitious. It's 2028, what they think it might look like in 2028. And so they've done a model and projections, but it's not it's not what's actually happened. It's what they think is going to happen. So fictitious might be a little bit of a strong word.
Right. And of course, remember that old adage, nobody knows nothing.
Yeah, that's true.
Brooke, thank you very much indeed. Brooke Thackeray, research analyst at Global X Investments Canada. Coming up, we'll find out why Canada may be more uniquely exposed to this backup tariff that US President Donald Trump is implementing. US President Trump yesterday threatened countries around the world to stick to any tariff deals they agree to with the US, despite the Supreme Court striking down many of his far-reaching levies on imports. Let's get more from Bloomberg senior editor for US economics and government, Derek Wallbank. Derek, thanks very much for giving us the time.
Thank you so much for having me.
Could you just update us here? Apparently, U.S. Customs is saying, this new tariff is going to be 10%. It's applying immediately. But U.S. President Trump had threatened 15%.
He had indeed, yes, and we're waiting for the paperwork on that one to come down. But right now, the number is 10%. Obviously, 10% is very different than what Donald Trump had threatened across the entire globe. The Supreme Court said you cannot use the authority that you were using to be able to do that. Those tariffs all struck down on a 6-3 decision. Trump has sort of vented about that quite heavily and said that he's putting in 10%. That's actually triggered, and has said that 15% is coming. We're not quite sure when that will happen. Now, initially, the good news, if you're Canada, I think, is that there is maintained an existing exemption for all of the things that would be covered under the USMCA trade deal. But remember, that itself is under some amount of threat. Trump talking in skeptical terms about the prospects of negotiations for renewal.
Right. Of course, he does like to talk tough before any kind of negotiations. But as you say, there are fears that that whole deal could be jeopardized.
Well, there certainly are. And, Trump has said in no uncertain terms that he's not sure that he needs the deal. I think that, as you correctly identified, a lot of people have noted that the maximalist threats do not always become the policy reality. But at the same point, they're very rarely nothing either. So the idea that Trump always chickens out, as the popular phrase goes, may not be quite it. It may be Trump always comes down to something that's more than nothing and less than what he was talking about originally. But Canada is under a particular threat from a lot of these. I mean, you've seen this White House take some amount of delight in trying to poke at Canada over any number of different things, you know, from hockey to trade, and most recently the idea of whether or not the president would allow the Gordie Howe Bridge connecting Detroit and Ontario to open at all later this year. So there are a lot of these individual pinch points. The other thing that I have to mention is what happens with this backup sort of trade authority that Trump is seeking. In very simple terms, a lot of this is very product specific. And when you are a country that is a big resource exporter, as Canada is across a lot of those, there are some of these moves that could be targeted to Canadian exports just by virtue of the fact that Canada happens to export some of the things that are somewhat easier to kind of go through the process on. And so while we're hearing signals from the United States that overall they kind of want to strike a balance with tariff levels where they were, it's going to be really important to see how this goes in process over the next 150 days.
We're tight for time, but we have heard from the Federal Reserve of New York and elsewhere that U.S. consumers are paying these tariffs. Is there a chance that in advance of the midterms, Trump might veer on policy to reduce the impact of the tariffs?
I do think that Trump is going to feel some amount of pressure related to the overall health of the economy. Polls suggest that voters in the U.S. overall have soured on his overall stewardship of the economy. And this is a president who has long said, look at the stock market, that's how we're doing, and you should feel good about things. So to the extent that pricing pressure becomes an inflation problem, to the extent that any of this weighs on markets, you will see the president maybe be a little bit responsive to that. And certainly we're seeing Democrats make an issue of tariff refunds, suggesting that the president owes their constituents more than $1,000 apiece. This is going to be a Democratic messaging effort.
Yeah, apparently FedEx wants a whole bunch of money back, as do other U.S. companies. Thank you very much, Derek. Really appreciate it. That's Bloomberg's Derek Wallbank. Okay, we've got lots more coming up. Today's ETF report focuses on the huge growth in popularity of actively managed ETFs. In today's ETF report, we're looking at the surge in popularity of actively managed ETFs. We got perspective on this trend in a Bloomberg interview with Travis Spence, global head of ETFs at JP Morgan Asset Management, and he touched on what's driving the trend.
As we think about kind of where we're seeing demand and what clients are looking to do, it's not in passive. We're seeing a big bid going into active management. That's been there for years in the mutual fund industry. 80% of mutual funds are active. But if you look at where flows are going in the ETF industry now, about 40% of all fixed income flows are going into active fixed income ETFs. And we think that that's just a better place for many investors to think about investing in the fixed income markets. I kind of think about, passive management within fixed income as having a blunt instrument in a precision industry. I'm thinking about the old adage of being a bull in a porcelain shop. This is where you want to be active because you can take advantage of both credit as well as duration plays. And so what we've seen in the active ETF industry, there's almost $40 billion that's gone into active fixed income ETFs this year. Again, that's about 40% of all the fixed income ETF flows. And what we're seeing on our platform, we've really gone all into the active fixed income ETF arena. We've launched 35 ETFs globally. 15 of those are in the U.S. now. We just crossed over $100 billion in assets under management. The three ETFs that I think are really relevant for investors now on our platform in the U.S. J-bond, JCPB, and JPI. J-bond, think about that as your core exposure, your core active exposure. JCPB goes into the core plus space. And then there's still a big demand for income, and that's where we see JPI. Each of these have taken in about $4 to $5 billion over the last year alone.
Travis, so when we think about income and bonds, one of the things with bonds and bond ETFs is they've got a lot more competition, including from your own funds. Like JEPI is known as an income replacement, and now you've got auto-callables, which yield even more than JEPI. And if you look at the derivative income space, this is a really fast-growing area. It includes JEPI and auto-callables. Its market share versus stock dividend ETFs has gone up from 9% to 25%. That's a lot of market share to eat up in only a couple years. So what about those? Like, why would I use those or not use those versus using bonds, which are going to give me less income?
Yeah, look, I think that, what we've seen is that derivative income category, and I know, we've been covering that together with you for many years now. We launched JEPI back in 2020. That was a mutual fund before, and it came into an ETF. It's actively managed. But we've really seen that space grow. We've seen more than 200 other ETFs come into that space. As you've seen on that chart, the total assets in the derivative income space are now almost 150 billion. It continues to be the number one active ETF category in terms of net flows, both last year as well as this year. So I think there is that insatiable demand for income across the market, whether you're getting that in the fixed income markets, where you also get a ballast against equity with correlation, or in these derivative income strategies, which also provide some downside protection because that correlation to traditional equities goes down as well. And so you're getting maybe 2/3 of the volatility that you see in normal equity markets. But I think where it's been really useful is to stay invested in the equity markets, and as they have run, a long way in the last few years, that's been a great way for investors to remain invested in equities, but still get that enhanced income. So I totally agree with you, Eric. That's been a big area for growth. It continues to be a big area of focus, and you're getting real yields. JEPI and JEPQ, the two main ETFs that we have in that space, are giving almost 7% and almost 10% of yield right now. Right. But again, you're keeping invested in the equity market.
Travis, I want to talk to you about this category that you're involved with, which is active ETFs. In my opinion, this is the hottest real estate on Wall Street because the flows are enormous, right? We're talking hundreds of billions of dollars. You can make a little more than you can in passive. And you guys have just absolutely crushed it in this space. DFA, Capital Group, and yourself. But if you look at here's a great chart showing the market share historically for active ETFs. It is a horse race. I mean, you can see ARK there was number one for a hot minute. First Trust was number one before that. And man, this is going to be fascinating to see how this plays out over the next 10 years.
JP Morgan's number 2 right now, right?
JP Morgan is second. And you got a lot of people nipping at your tail now. And I'm just curious, what you think, how will this chart look in 5 years?
Yeah, it's a good question. I mean, as you said, there's a lot of new entrants coming into the space. The one thing that I would observe, and to put some additional numbers behind it, about 120 billion that's gone into active ETFs so far this year. That's well above the total of 475 that we saw in the U.S. market last year. So we're really seeing the pickup in active ETFs happen.
Okay, active ETFs. It's almost like a contradiction in terms, of course, with the idea originally with ETFs was you just track an index and you don't have some genius picking the stocks for you. Coming up next, we'll bring you today's latest headlines and update you on the markets, including electricity generator Emera hitting a record high. Shares in Constellation Energy up about 4%. That major America electricity producer saw annual revenue grow by 13%. It pointed to favorable market conditions. The utilities company is increasing its annual dividend by 10% and plans to expand it another 10% in 2026. However, Constellation held off on issuing a forecast for the year. It says it'll provide guidance during an investor call on March 31st. And Whitecap Resources saw fourth quarter profit and revenue rise year over year. The oil and gas company says that combining its operations with Veren last year is one of the drivers for growth. Whitecap posted record quarterly production on oil, and it has entered into a long-term agreement with Centrica Energy, under which Whitecap will supply that British energy company with nat gas starting in April of 2028. Shares in Novo Nordisk down again, losing 2% today. That Danish company plans to slash U.S. list prices for Wegovy and Ozempic next year by as much as 50%. This comes as the drug maker struggles to claw back a larger share of the obesity market. The cuts apply to wholesale acquisitions and not self-pay prices. However, they may reduce out-of-pocket costs for some patients. And you can see North American markets now up. The software industry busily trying to fight back against perceptions that AI is going to demolish its profits. For example, Thomson Reuters saying companies in many cases have not earned a return or an adequate return on their investments in artificial intelligence. Shares in Nova Scotia-based energy company, mostly electricity, also natural gas, have hit a record high today. The company did report a drop in fourth quarter earnings, but underlying profit for the full year was up about 19% to hit a new high, topping $1 billion. We heard yesterday from Scott Balfour, President and CEO at Emera.
2025 was a record year for us with our adjusted earnings per share up by 19%. And the real driver for that is our businesses in Florida, which now represents about 72% of Emera's earnings today, and is really the driving force behind our growth in 2025 and our forward-looking growth as well, including most of our capital deployment.
And gas is it's not a rounding error. It was almost $300 million in earnings last year. Where are your gas assets?
Yeah, so currently we have two gas utilities, one in the state of New Mexico, which we're actually in the process of selling, awaiting a final regulatory decision there that we expect sometime any day now in terms of a recommendation on the closing of that transaction, which we expect to happen before the end of the second quarter. And then in Florida. So in Florida, we actually have two businesses, Tampa Electric, serving electric customers in the greater Tampa area, which represents about almost 60% of Emera today. And then the other is Peoples Gas, which serves about half of the gas-connected customers in the state of Florida today and is one of the fastest growing utilities in the country.
So your stock trading near record highs right now. It's had a great run. Your profit per share jumped last year, was almost $3.50 a share, up from just under $3 in the previous year. But there was a decline in the fourth quarter. Why was your profit down in the latest 3 months, Scott?
Yeah, largely as a utility, we're fortunate that we have pretty good insight and foresight into our earnings profile. It's one of the things as a sort of a company that owns a number of regulated utilities is providing stable and predictable earnings and cash flow to deliver value to shareholders. But we do get at times impacted by weather. And so in the fourth quarter of 2025, we had sort of more temperate weather, particularly in Florida, that just meant our earnings for the quarter were a little bit lower. But of course, as you highlighted, for the full year, our results were very, very strong.
Is Florida seeing much in the way of construction for data centers? I was wondering, does that point to bigger demand for you?
Yeah, it's a really good question, Andrew, and certainly data centers are a big part of the story for electric utilities today in the United States. Florida has not been front and center in that discussion, but it is increasingly happening now. We are in a number of advanced discussions with a number of large load type customers, data center type customers, and we're quite optimistic that we'll see some traction with that this year in 2026.
I'm just wondering, because Florida's hot, does that make it less attractive to locate a data center? You might have extra cooling costs?
Yeah, you're picking up on a good theme. However, electricity costs in Florida are also lower than in many places, and the reliability of the electric system in Florida is actually very, very strong. In fact, leading the nation in many respects. And of course, it's hot in other places that has a lot of data center activity going on, including Louisiana and Texas. So Florida's not unique in that way, but it does have a lot of things to offer an advantage. And one of the most important, of course, is there's capacity. There's generation and energy capacity to be able to serve these customers, and that's certainly why we're seeing some interest with some potential customers at Tampa Electric.
Yeah, that's a bit of a sore topic, apparently, in many parts of the U.S. People blaming data centers for pushing up electricity prices.
Yeah, and it's interesting because, yes, that's true in some regions, but in the regions that we operate are mostly integrated markets where as a utility, we're not just responsible for the transmission and the distribution of the energy to customers, but also the generation, which means we have the planning cycle for all of it to make sure that we have enough energy for all of our customers. And of course, one of the really important things when we're pricing these large load type customers is to make sure that they're paying 100% of the incremental cost to serve them, plus a little bit more. And in fact, I think the real story with data centers moving forward is how it will help customer affordability, as opposed to in some markets. I know that it's been more of a challenge, but certainly in Florida, in our conversations with Tampa Electric, we see this as a story that actually will help affordability issues with our customers.
Sorry, what do you mean discussions with Tampa Electric? What is Tampa Electric your operation there, or?
That's right. Tampa Electric is our largest business today, almost 60% of Emera today, and they're in a number of conversations with prospective data center type clients.
So if you were to put in new gas-fired capacity, it must be a bit exasperating, though, or is it frustrating trying to get contractors and equipment? There's such a building rush in America. Is it hard to even get them on the phone?
Yeah, well, I think one of the challenges that everyone is working through is long supply chains for major key equipment like gas generators and transformers, which is why we've shared that we're actually already in a queue for 2 large gas turbines, GE turbines that we expect to be delivered in the next couple of years in order to serve the growing needs that we've got generally for all of our clients, including prospective data center type clients. So yes, it's a challenge that everybody's working through, and maintaining trusting relationships with the contractor community, with the major equipment suppliers is certainly part of what has us excited about the prospect for us in Tampa in particular around serving some of these new large loads.
Sorry, we're tight for time, but your dividend yield just over 4%. Can you remind us, what is your policy on the dividend? Do you try to increase it every year?
Yeah, in fact, we've increased our dividend for the last 19 years in a row. And our guidance to investors is we will look to continue to increase the dividend each year in the range of at least 1% to 2%.
1 to 2, so not massive growth. And you declare, is it usually in the fall that you raise the dividend, or?
That's exactly right. Okay, yeah, we usually make that declaration in the fall. Of course, that's a board influenced decision, but that timing usually in the fall.
Scott Belfer is the boss of Emera and spoke to us yesterday. We have lots more coming up on the Open, including a look at 3 media plays on Hot Picks. Time for Hot Picks, and we are looking at media and entertainment. Our guest has Live Nation as his top selection. He says the company is well positioned to benefit from strong demand, and that antitrust fears are already more than priced into the stock. We're joined by Jason Bassinet, Managing Director, Media and Entertainment Research at Citi. Jason, great to see you, and thanks very much indeed.
Yeah, happy to be here.
It is incredible. We hear stories of people willing to pay massive prices for live shows, and that's boosting Live Nation.
Yeah, I mean, we've been on I'd say a 2-decade journey now where consumers are increasingly wanting to go out and see their favorite artists in person. And so the concert business has been growing, very comfortably in the double-digit pace now for quite some time. And we don't see any evidence that that's going to end. The thing that's exciting about Live Nation is they're about in the third year of, I'd call it backward integrating into more venue ownership, which carries much higher margins. And so this company used to spend a couple $100 million a year on CapEx. For the last couple of years, it's been over $1 billion. And that's a very good thing because their returns on invested capital are at record levels. And we just want them to keep spending money. When they spend the money and they own the venue, they just get much higher margins because they get site lease fees. They control the food and beverage at the venue. They get sponsorship revenues. And so it's a very favorable mix shift.
And just tell us, so they've been on a real estate buying spree?
Yeah, they've been acquiring venues outright. They've been building some from scratch. They've been deploying capital to renovate older venues and give them a refresh. One of the big assets they just bought was a sports complex in Paris, and they're retrofitting it so it can handle concerts. And so it's a very exciting time for Live Nation.
And apparently they're so, you talked about hospitality, which would include beverage sales. Apparently, I hope I'm not out of date. I'm looking at a 2024 story. Apparently, you could buy a can of liquid death water, the exclusive water vendor at hundreds of Live Nation venues for $7 US. And Live Nation has had an ownership stake in that water brand for quite a few years. So they make money in all kinds of ways.
That's absolutely true. I mean, at their amphitheaters, the average fan is probably spending, $45 to $50 on merchandise, food, and beverage. So there's just an insatiable appetite on the part of consumers. Live Nation used to call themselves, an accidental retailer, where you'd get a warm beer and a cold slice of pizza, and they've been, radically upgrading sort of their offerings to appeal to consumers that are willing to spend more money to get something that's better. And to your point about liquid death, I mean, there's clearly a push for consumers to be a bit more healthy than they were in the past. And so they don't just sell alcoholic drinks, but they also sell water.
Tell us about AppLovin. To my understanding, this company makes it easier to create your own video game.
Yeah, it's not so much create your own video game. Their customers, their core customers, about 90% of revenues are the video game, mobile game customers themselves that are looking for installs. And so they can go choose to spend their user acquisition money on their own, or they can choose to do it through AppLovin. And AppLovin has some AI tools that can put the right ad in front of the right person.
Oh, I see.
To make the user acquisition spend more effective for the mobile game publisher. In very short order, AppLovin has gone from an AI winner to an AI loser, which is why the stock is down. But this company, continues to put up, 70+% growth. They've done that for the last 4 years. Where the stock is trading right now, even with that very healthy top line growth, it's trading at a high teens multiple of next year's free cash with no debt. I mean, it's just absolutely on sale.
Right. And that's interesting. So the app developers are the ones it's aimed at, not so much the consumers.
That's exactly right. So the way it works is the mobile game publisher sends AppLovin, says, I want to spend some money, and AppLovin and goes out and buys mobile game inventory on behalf of the publisher. And then AppLovin gets paid if the consumer actually downloads the game.
And then your final idea here, also video games, Take-Two Interactive.
Yeah, I mean, we've got Grand Theft Auto 6 coming out in November. That sort of consensus, I wouldn't say we're variant there. The really interesting thing that I'm focused on is on the balance sheet. They have a line item they call capitalized software development costs, which is essentially cash that they've spent developing games that have not yet been released. That number used to be a few $100 million. It sits at $2.2 billion. And my hunch is that there's a game that where the company has spent the cash but not yet released it and therefore not amortized it.
Oh.
That is Grand Theft Auto, but I think it's something else. And I think that something else might be a Red Dead reboot, which came out almost a decade ago. And so what I'm excited about for the stock is not just the Grand Theft Auto release in November, but potentially a Red Dead release maybe the year after.
What is Red Dead? What sort of a game is that?
Oh, it's like an open world Western. That's the way to think about it. So, you'd ride a horse and you have a gun and you walk around. And it's considered by video game aficionados as, maybe the most realistic open world game that's out there, even more so than Grand Theft Auto.
Oh, my goodness. And I guess we're just in the Stone Age. Games are going to get more and more immersive, aren't they?
Yeah, I think they are. I mean, that's what's very interesting. The market right now is just looking at all of these AI tools and viewing it as just a negative across the board. The market's painting with sort of a broad brush. I would argue that a lot of these tools are going to be used to lower the cost of development for a lot of these publishers.
Mm-hmm.
I mean, going back to App 11, if you let's say you take the maximalist, AI view, which says AI can just create games, at low cost, everywhere for everyone. What's really going to happen is user acquisition prowess is going to be at a premium, right? This is why the mobile game companies spend so much. They spend 30% of their revenue acquiring users. Why? Because it's so easy to make a mobile game. So if you believe in AI and you think it's going to be really easy to make a game, that should redound to the benefit of a company like App 11 that specializes in user acquisition.
Because the cost as games become more complex, the cost of creating them has soared.
Yeah, that's right. So AI will make it, I think you'll have more games, cheaper games. There'll be a proliferation of games out there. And then having user acquisition, acumen, which is what App 11 does, should be at a premium. Because at the end of the day, you need to get an install, right? It's not enough just to have some fancy graphics on a screen, which is what Gemini and others, are rolling out. It's like, how are you actually going to get users? And that's hard, and it takes a long time.
It's interesting. We're almost out of time, but apparently older adults, especially baby boomers, they're all over video games. It's not just a teenage boy thing.
Oh, that's 100% right. I mean, your typical consumer on the mobile gaming side is an older female. On the AAA games, you're right. It's about half male, half female, and it spans all age groups. I can't say on the AAA games, like Grand Theft Auto or Red Dead, that we're seeing a lot of volume growth.
Okay.
Where they're getting most of their growth is getting consumers to spend more inside the game once they purchase it.
Right. I think I'll avoid it though. I'm in the dream. I'm in the dream world enough as it is. Jason, thank you very much indeed. Jason Bassinet, Managing Director of Media and Entertainment Research at Citi. Coming up, we'll take one last look at the markets. We've seen something of a recovery in U.S. stocks from yesterday's sell-off. And we'll also look ahead to tonight's State of the Union speech by U.S. President Donald Trump. Welcome back. If you missed a market call yesterday, as if you ever would, it's probably worth watching the replay. We were joined by Jerome Haas, Portfolio Manager at Lightwater Partners, and he covered Canadian mid-cap stocks. His top ideas were Total Energy Services, Surge Energy, and Fairfax Financial. And today on the show, it's Ernest Wong, Head of Research at Baskin Wealth Management. The topic, North American large caps. And another reminder, Know Your Options is back. Tune in tomorrow at 3 p.m. Eastern Time to get all of your options trading questions answered by Chris Tom of Moat Financial. Send us your questions right now to knowyouroptions at bnnbloomberg.ca. That show goes out every 2 weeks, Wednesday, 3 p.m. Eastern Time. Yesterday, Loblaw said it will invest almost $2.5 billion this year, with plans to build 70 new locations and create more than 9,000 jobs across Canada. For more on the investment, CTV's Adrian Gabriel filed this report.
With Canada now home to the highest rate of food inflation among the G7, one of the country's largest grocers is setting the table for a sizable expansion.
It says we're here, we're optimistic, we want to continue to grow.
Loblaw Canada is investing $2.4 billion in 2026, with plans to build 70 new locations and create more than 9,000 jobs. The National Grocers plan will focus on building new Shoppers Drug Marts, No Frills, and Maxis for budget-focused customers.
I think it's definitely a sign of the times.
Loblaw says it plans to open 4 new stores in Atlantic Canada, creating 600 jobs. 15 new locations in Quebec will create more than 1,985 positions. Ontario will receive the largest boost with 27 new stores and 3,775 additional jobs. Provinces to the west will welcome 24 locations, creating more than 3,400 roles with the company. Food economists say grocers are taking notice of cost-conscious consumers.
Grocers focus on 2 things. The first is share, that is getting people to walk into your store. And the second is basket, which is how much they spend when they come in. And if either of those goes down, they feel the pinch.
A statement from Loblaw in part says that opening new stores and pharmacies, especially in underserved areas, will help make value and healthcare more accessible.
They're not leading consumers, they're responding to changes in consumer buying habits.
Loblaw's push to expand its discount options is part of the company's 5-year plan to spend $10 billion by 2030.
Some economists expect the company's upgrades to look similar to this. Just 2 years ago, this was a Loblaw's. It's since been rebranded and retrofitted as a No Frills, a sign of a shifting marketplace. Adrian Gabriel, CTV News, Toronto.
It was interesting. They showed a shot there of one of the Loblaw's no-name stores they announced a while ago. They would be hardcore discount with just generic products and even a lack of freezers or refrigerated, if I remember correctly. I contacted the company to see how that's going. And they said, we had 3 in Ontario, 2 have closed, but we're still working on it. But they said we didn't see the uptake that we had planned initially. So that one, you try new things, and that one apparently not working out. But they did open a few of them. Let's have a look at the markets. We'll check in on the TSX first off. And 33,806. I'm trying to see if we're back in record territory. We did hit a new high on Friday. So 33,806, not far shy of 34K. We're not quite back to the 33,817 at which the market closed on Friday. Let's have a look at Air Canada, Puerto Vallarta, Bank of Canada. Sorry, control room. They call me the confuser. That's my superpower. Bank of Nova Scotia, that stock actually pretty flat right now, even though earnings beat expectations. But the shares, as you can see, up more than 44% in a year, excluding dividends. Thomson Reuters, what a rebound from a low base, but up 13% right now. So the company pushing back against fears that its business is vulnerable to AI. The company announced what is being seen as something of an AI milestone. It said it hit 1 million users of CoCounsel, its legal and business artificial intelligence tool, and said that it's working with Anthropic's Claude model. So CoCounsel, it's a lawyer that you don't need to buy a Lexus for it. Let's have a look at Air Canada. It and rivals resuming flights to Puerto Vallarta in Mexico. Apparently the situation is stabilizing a bit there. And U.S. markets, let's check them out. We do have President Trump with his State of the Union speech today, and that's at 9 p.m. Eastern Time. He is expected to hit on what he says he's doing for affordability for Americans. But of course, his tariffs have been paid apparently mostly by U.S. consumers. He is expected to tout things like a website allowing people to get prescription drugs more cheaply. But this is a crucial speech because the Republicans want to have the initiative heading into those midterm elections later this year. I think we better jump. Thank you very much indeed for watching The Open. Morning Markets is next.